you're thinking about buying a home or selling your current home, you're probably very aware of what's been going on with mortgage rates in the last couple of years. As a real estate broker, I'm frequently asked about interest rates and why and how they matter so much. In this video, I'll give you a good idea how, in real numbers, a mortgage interest rate affects your purchasing power, your monthly payment, and ultimately the cost of your home over time. Hi, I'm Stacy Butchart with Windermere Realty Trust. This channel is all about living in Portland, Oregon. What's good, what's not so good, what to expect in our fair city, and all it has to offer, along with all you need to know about moving here and about buying or selling a home in the Portland metro area. If these are topics that interest you, you might just want to hit the subscribe button and click on the bell so you'll be notified every time I drop a new video. And a hearty thank you to all my subscribers. I so appreciate it. So, let's get on with it. Wow, what a year for so many reasons, but also with regard to mortgage interest rates. In the last year or so, we've seen ridiculously low rates. In fact, in 2020, mortgage interest rates hit a new all-time low 20 times. Well, apparently that trend is over as we see the economy start to recover and rates are starting to head back up a bit. And from all the info out there at this time, this new trend is going to continue for the most part. But let's be clear, rates are still unbelievably low. Let's just take a look at the history of mortgage rates over the last 50 years. Note that in the early 1980s, rates were nearly 6 times what they are today. 6 times. Can you even imagine paying 17 or 18% interest on your home? So, as a home buyer or seller, when you hear that interest rates are really low or interest rates are going up, what does that really mean for you? Well, there just happens to be a magic number that will really help you figure that out on the fly. And that number is 11. A difference of 1% in interest rate changes your purchasing power about 11%. Easy to remember, lots of ones in this equation, and easy math. You gotta love that. So here's that calculation in play. Let's say you can afford a $500,000 house based on what you can comfortably pay per month and or your debt to income ratio. And that's definitely your max. And suddenly interest rates go up 1%. Now you can only afford a $445,000 house. And that's $55,000. And not only is that a good chunk of change, that's a down payment or part of a down payment. It's also a nice car or several wonderful vacations in fabulous places. And by the way, when working with buyers, I generally recommend they do think in terms of the monthly payment they want or can afford to pay rather than just the home price. From that perspective, if interest rates go up by 1%, a monthly payment of $2,000 is suddenly around $2,200 and change. Full disclosure here, this is a pretty simple example and is based on principal and interest only. So it doesn't factor in all the other things that alter your monthly payment, such as changes to your credit, the size of your down payment, the loan type, or the amount of property taxes. And of course, rates generally don't go up a full 1% at a time, thank goodness. The Federal Reserve changes the benchmark federal funds rate, which is the rate that financial institutions use to lend money to each other, about 0.25% at a time. But even an increase of just half a point in mortgage rate, here the example is 2.81 to 3.31%, makes a big difference. On a $300,000 mortgage, that difference, including principal and interest, is $82 a month, $984 a year, or get this, a total of nearly $30,000 over the life of the home loan. If the additional monthly amount doesn't seem daunting, remember you could ultimately pay tens of thousands of dollars more for your home over the long haul. And friends, that money is just gone. Interest doesn't get applied to the equity of your home, just principal, just saying. So here's my advice in this current market. Buyers, if you're thinking about buying a home and you've got all your little ducks in a row, do yourself a favor and buy sooner rather than later before interest rates go up again. Remember, waiting is literally costing you money in both higher mortgage payments and in how much you pay for your home, and it may limit your purchasing power. And for those of you that are considering selling your home, in a market where interest rates are likely to continue to climb, you should also think about selling sooner rather than later. The higher those rates go up, the fewer the buyers that can afford your house. And the smaller the buyer pool, the less likely you'll get the best price and terms available. Bottom line, you'll do oh so much better if you get your house on the market while we're still in a seller's market and there are plenty of buyers who'd really like to take advantage of low interest rates. So I hope this was helpful information. And now you've got a simple rule of thumb to use to figure out how much a difference in interest rates affects your purchasing power. And if I can help you find the right home or sell your home here in the Portland metro area, please let me know. I'd love to help.